Hello everyone, welcome back to the Joyful Investors channel. If you have been watching our series on income investing by now, I'm sure you will be pretty clear about what income investing is and the benefits that come with it. Income investing looks to be one of the solutions to financial independence, as long as your income generated is enough to offset your living expenses. Most often than not, those stocks are usually stable investments that pay out dividends reliably. And to sweeten things up, Singaporeans are fortunate to be exempted from paying taxes for the dividend income. While income investing sounds like a great path to pursue as we work towards financial independence, there are in fact some untold truths that are rarely mentioned in mainstream media or financial trainers. In this video, we would like to share some important but less known truths about income investing that many investors may only realize after dipping their toes into it. As usual, the purpose why we are doing so is to paint a more accurate picture to wannabe income investors so that they know what they are signing themselves up for. In order to be able to stay joyfully invested over the long term, we must be able to embrace everything that comes along, including the negative parts. Before I share the untold truths of income investing, greatly appreciate an early thumbs up to support the channel and click on the subscribe button to learn more about investing. First untold truth, the worth of the same dividend gains diminish with time. The cost of living can and will only increase over time. In a short time period, this may not be obvious, but when we talk about retirement planning, it is reasonable to picture something that is at least 15 to 20 years down the road. A dollar received today is not the same dollar value 10 years later. It would be reasonable to assume that inflation may be 2 or 3% annually, which is normally the basis in CFP programs. What this means is that the purchasing power of our same dollar will diminish to some extent over time. Hence, to get an even more accurate projection of retirement planning using the expense method, you have to calculate in terms of the future value of the living expenses that you need by incorporating the inflation rate to future expenses instead of using just a fixed expense of say 2K a month to project into the future. So in practice, you may only need 24K of dividends right now to live off dividends, but in the future time to come, you will need more than this figure for future consumption due to inflation. Point number 2, let's say we ignore the purchasing power of a dollar in the previous point. Even if let's assume that we don't live in an inflationary world and that expenses will stay the same, the truth is that dividends may not be constant nor guaranteed. Companies are not obligated to pay a dividend, and they are also not obligated by when they need to pay a dividend. When times are tough, companies can definitely cut dividends or choose not to pay any. For retirees who are depending on that regular stream of income, they will suffer. During COVID-19, some of the Singapore REIT lowered the dividend payouts to meet the ongoing operating challenges. Investors who are relying on this recurring dividend income will be affected. This also comes at a time where most people are probably facing other challenges in their business or job security. For Singapore bank stocks, which is a favorite among Singapore retirees for the dividends, the Monetary Authority of Singapore stepped in to impose a dividend restriction on the local banks. Banks were told to set aside a portion of their earnings in order to absorb future economic shocks. They have to cap their total dividends for 2020 at 60%. Of course, by mid-2021, this cap has been lifted thankfully, but these are events that transpired and can always happen again in the future. How then will these investors be able to finance their ongoing expenses at that point in time? If you are a retiree who purely just live off the dividends, you could be in for a rude awakening. If you were to liquidate part of your investments to finance your expenses, the shares at that point in time are likely to be sold at a very unfavorable price. Some may suffer more in capital losses than what they got in dividends over the years. And for some other investors, seeing that dividends are going to be slashed, they may be tempted to sell away the shares, leading to even more selling pressure in the markets. So, dividends may not be guaranteed. This is not an obligation for companies. The third untold truth, it is not just that the dividends may be worth less over time, that dividends are not guaranteed, but also that the initial capital that you put in is at risk of loss too. Just like any other stocks, dividend stocks themselves are also subjected to reasonable volatility as well. They have often been portrayed to be supposedly more resilient and more stable. But let's take a look at some of the more popular Singapore REITs. During the COVID-19 crash, the paper loss suffered from the crash at that point in time would have easily outweighed, say, 5 years of collected dividends. But of course, if it is a good REIT and you allow the price to recover over time, it will eventually be fine. But the problem comes in that most retail investors may just panic sell during those times. But it's not just these black swan events that cause volatility or huge swings. Being stocks and being cyclical in nature, barring any other black swan event, there will still be volatility in the markets for these stocks. If we were to look at one of the good retail REIT, say Fraser Centrepoint Trust, ticker J69U, the pullbacks of 10% to 20% are not uncommon to see. Imagine if you have just bought into this REIT and have only collected 1 year of dividends at 5% yield, but the stock price fell by 15%. So net, you are still down by 10%. Basically, investors must grapple with the fact that a REIT portfolio is not a sure gain 5% kind of proposition without any other drawbacks. REIT stocks can just be as volatile as other types of stocks. That said, of course, some investors, especially retirees, they may not even have the intention to sell off their investments, and they have strong hands. Hence, this may be less impactful to them. With their sizable amount of investments, they are happy to live on their dividends forever. So bear in mind that dividend investing is not necessarily always safer or always more stable. It still depends on the underlying that is being bought and whether it is being bought at a good margin of safety. Untold truth number 4. Building a REIT portfolio is a reasonably long building process for most people and not as easy as a money printing machine as it is usually touted to be. Most beginners start off with a small pool of funds available for investing. Anything less than 50k is not a very significant amount because at 5% yields, it is just 2.5k a year or just over $200 a month. It is good extra pocket money to have, but surely not an amount that is life-changing. It only becomes sizable at, say, a 500k portfolio, which may then generate 25k a year at 5% yield, and that works out to be about 2k plus a month. That said, all big things have small beginnings. It never hurts to start small, but most importantly, it is to have the right expectations and not to lose sight of the bigger picture, even if the current dividends may seem paltry. The fifth untold truth, dividends come at the expense of capital gains somewhat. By paying out dividends, it actually means that a company has less money to expend, which of course it may not want to do so, or it may not have to expand. but that is what it means. Dividends are derived from a company's profits. So thus, instead of using the money to expand the firm, the company will reward its shareholders by paying out the dividends. In some sense, one will be sacrificing some of the capital gains with a dividend portfolio. For investors who are much younger and have a longer investment time horizon, and you do not need regular income, chances are that they would probably end up with more money by investing in the right growth stocks over a long period of time, as compared to pure dividend stocks. This is a trade-off which investors with a long runway should be aware of. The last untold truth. When talking about receiving dividends, naturally most new investors will want to look for something that supposedly gives the highest yield. But what happens is that they will fall into what we call a high yield trap. Most often than not, yields are high for a reason. The yields are high to commensurate certain aspects of risk that may be associated with the underlying stock. Some of you may recall that there is this specialized business trust called the First Ship Lease Trust that used to pay really good yields. But it was short-lived as the financial crisis of 2008 broke out and they could not pay their dividends. Certain stocks may pay higher than usual yields that come with country or industry specific risk, which can happen when you least expect it. The higher yields could also obviously be a result of a lower share price based on the formula. When the company's share prices drop because investors are concerned about its future performance or concerned about its ability to sustain its dividend payout, then there is going to be selling pressure, which leads to a fall in the share price. But when we calculate the previous distributions based on the lower share prices, the yield is going to be high for sure. But it is not necessarily a good investment. Hence, buying a stock or REIT based on yield alone is very dangerous. In short, there is no free lunch in the financial markets most of the time. With all this being said, the question is, do we still invest in dividend yielding stocks ourselves? The answer is yes, we do. There are many merits for dividend investing as we have shared in our earlier videos. But at the same time, we feel that it is very important for us to paint a realistic picture so that you know what you sign yourself up for if you decide to go for dividend investing. Problems happen when most investors do not know what they are in for, and some financial media very often only portray the benefits until investors are in for a rude shock when the inevitable happens. At the Joyful Investors, we believe in empowering investors to be able to have the right kind of expectations for the financial markets, whether or not you are looking for growth investing or income investing. Investing should be a simple and joyful process, but that is if we learn to appreciate what is going to happen with all the good and bad things that can happen altogether. If you do not wish to miss our next video release, click on the subscribe button now. You may also follow us on our Telegram channel for more investing insights. See you in the next video.